Hello friends, let's start the next topic, that is interest on drawings. So most of the time what happens is that in a partnership firm there is a chance that the partners might be in need of some money for his personal use. So whatever expenses he is going to incur, obviously it is not going to be, if it is not going to be business purpose, we'll treat it as drawings. So this money which the partner takes has to be, either it has to be repaid to the firm so that his drawings are closed, or ultimately it gets adjusted with his capital. So now keeping that in mind, so whenever the amount is going to be utilized by the partner for his personal use, not for business use, we have to pay interest. As a partner, they have to pay interest on such drawings. These drawings are going to be either treated as regular or irregular drawings for the because what happens is that if the amount is going to differ, or the period is going to differ, or the interval is going to differ, we will treat it as irregular. That is, he might take randomly. For example, you can just go to illustration 26 on page number 2.40, where you have the drawings which are taken on 1st May, that is, he has taken 2000 rupees. On 1st August, he has taken 5000 rupees. On 30th of September, he has taken 2000 rupees. So in this problem, you can see that the dates are different, and also the amount which he has taken is different. So these kinds of drawings are called irregular drawings, and we have two methods in this irregular drawings. That is, first one is going to be your simple method, and the second method is going to be your product method. So let's start with the simple method and just see how we have to calculate the interest on drawings here. Now if you go with this problem, you can see they have mentioned that the interest on drawing is at 15% per annum during the year ended 31st March, and the partner withdrew 1st May 2000, 1st August 5000, 30th of September 2000, 31st of January 6000, 31st March 2000. So totally there are 5 drawings during the year, and we have to just list down the drawings along with the dates. Okay, so we'll take the simple method first, and we'll write down the dates, we'll write down the amount, and next column is the number of months till 31st March, because we have to calculate the number of months from the date of drawing. So for the first one, which is 1st May 2021, 2000 is a drawing. So we have May, June, July, August, September, October, November, December, Jan, Feb, March. So totally you have 11 months to pay interest on those drawings. Now the next drawing is on 1st August. So August, September, October, November, December, Jan, Feb, March. So you have 8 months to pay interest. Then 30th of September. So September is over. So we will start from October, November, December, Jan, Feb, March. 6 months. And then coming to January 31st. So again January is over. So we have Feb and March. 2 months. And on 31st of March, since the last day of the year, there is nothing to pay as interest. So it will be 0. So now once we have found out the number of months, we have to find the interest for each of the drawings. Okay, the formula has been mentioned at the bottom of the solution over there. You can see that interest will be calculated at 2000 rupees into 15 by 100, which is the rate, into 11 by 12. Same way we will do for each of the months. So for the 1st August, we will do 5000 into 15 by 100 into 8 by 12. Same way for 30th of September, we will do 2000 into 6 by 12 into 15 by 100. So like this we will calculate interest for each of the drawings, and you get the total interest as 1075 rupees. Now coming to the product method, that is the second method. When you are going to go for irregular drawings, you are going to simply find out the same way. You are going to find out the dates, amount, and number of months. So the difference over here is going to be your product. The last column, you will multiply the amount along with the number of months. Okay, so the amount is going to be 2000 rupees, and the number of months is 11. So the total product will be 22,000. So same way you have 22,000, 40,000, 12,000, 12,000 and 0. So the total is 86,000. So we'll apply the formula for product method, which is different from your simple method. So we have to simply take the total of the products into the rate of interest by 100 into 1 by 12. We will not multiply the number of months, we will multiply it as 1 by 12. So keeping that in mind, so your interest on drawings with respect to product will be what? The total of the product into the rate into 1 by 12. So coming to the next aspect, that is going to be with respect to regular drawings. So we have done with irregular drawings, the dates are going to be different, the amount is going to be different. But what if a partner withdraws money on a regular basis and the amount is also same? So let's see the two conditions which they have told. The amount of drawing is uniform and the time interval between the two drawings is also uniform. So both should be same, only then you can apply this method, otherwise you can't apply this method. So keeping that in mind, so the average period is nothing but the months left after the first drawing plus the months left after the last drawing divided by 2. That is the average period formula. So I repeat, months left after the first drawing plus the months left after the last drawing divided by 2. Let's take an example first. If I am going to draw every month beginning, so first of every month I am drawing 2000 rupees, right? So what is my first drawing? 1st April. When will be my last drawing? April, May, June. It goes till March month. So March 1st will be my last drawing. So when I draw on 1st April, how many months are there? April, May, June, July, August, September, October, November, December, January, February, March. 12 months are there. When I draw the last, that is 1st of March, I have left with only 1 month. So my average will be what? 12 plus 1 by 2. That is 6.5. So like this we have to calculate the average period based on the period for which the drawing is happened. So we will see one by one various situations. So we have situation 1 over here, where the partner withdraws the fixed amount beginning of every month and the interest is charged. So beginning of every month. So again going back to the same example, so I am going to calculate the interest on drawing. The formula is going to be total drawings into rate of interest into average period divided by 12. So now the challenge over here is to calculate the average period. The average period is nothing but the number of months left from the first drawing plus the number of months left from the last drawing divided by 2. So when I draw every month beginning, that means my first of the month will be the date of drawing, right? So 1st April, 1st May, 1st June, 1st July, like that till 1st March, because my cutoff is 31st March, so we'll see till 31st March. So my 1st April will be the first drawing, so that means I have 12 months left, and my 1st March will be my last drawing. So I will take 12 months plus 1 month divided by 2, that means 6.5 months is the average period. So the formula I am going to apply will be total drawings into rate of interest divided by 100 into 6.5 divided by 12. Okay, let's go to the next situation where the partner is going to draw fixed amount end of every month. That means he is going to draw on the 30th or 31st of each month. So that's the end of each month. So April 30, like that we are going to go on till March 31st. That means when I draw during the month end, first drawing will be in the month of April end. So that means how many months will be left? Obviously April is gone, so I am left with only 11 months. 11 plus my last drawing will be on 31st of March, that means there is nothing is left. So 11 plus 0 divided by 2, which is 5.5. I repeat, 11 by 2, which is 5.5. Next, when I do it in the middle of every month, that means I do it on April 15th, and every month 15th I do it till March 15th, because March 31st is my cutoff, so I do it till March 15th. So it is going to be like 0.5 of the first month is gone, so I am left with only 11.5. Okay, so from April 15th we will start, and then till 31st March, so that is 11.5, and my last drawing is going to be on March 15th, so 0.5 is left. So 11.5 plus 0.5 divided by 2, that is 6 months. So that is my average period. So it was really easy. If you can put a timeline kind of a diagram and do it, it will be very easy. Okay, no need to memorize all these things. Then when we talk about quarterly, we should all know that there are 4 quarters, Q1, Q2, Q3, Q4, and each quarter has 3 months. So keeping that in mind, we'll start with situation 4, where you are going to withdraw the beginning of each quarter. Okay, so when I'm going to draw in the beginning of each quarter, that means Q1 beginning, Q2 beginning, Q3 beginning, and Q4 beginning. Totally 4 drawings I can do, right, in a quarter. So when I do beginning of each quarter, so first Q1 I will start drawing, that is April, May, June. So I'm left out with 12 months. So 12 plus my last drawing will be in Q4 month beginning, that means I'm left with 3 months, the last 3 months, right? So 12 plus 3 divided by 2, that is going to be 15 by 2, which is going to be 7.5. Clear? So I repeat, if Q1 will be my first drawing, Q4 will be my last drawing, right? So Q1 when I draw in the beginning, that means I'm left with Q1, Q2, Q3, Q4. So totally 12 months. We'll do it in the form of months. So it is going to be 12 months plus Q4 will be my last drawing. So I'm left with only 3 months in that quarter. So 12 plus 3 divided by 2, which is 15 by 2, which is 7.5. Coming to situation 5, where it is middle of each quarter. That means each quarter has 3 months. Middle should be around 1.5. Okay, so Q1 middle, if I am going to draw, that should be mid of May. So when it is going to be mid of May, I am left out with 10.5 months, right? So 12 minus 1.5 is 10.5, and in the last quarter I am left with another 1.5 months. So 10.5 plus 1.5 divided by 2, that comes to 12 by 2, which is 6. Okay, so this is how we do for quarterly. There is one more situation where you are going to do the drawings during the 6 months. So we can do the same calculation but from October onwards, because when you are going to talk about 6 months, you can't go from April to September, but you have to go from October to March, because we have to close till March, right? So we'll start from October onwards and do the calculation. If you are going to do in beginning of each month for the 6 months, obviously how many months are left in the first drawing? 6 months, and the last drawing 1 month. So 6 plus 1 divided by 2, that is 7 by 2, which is 3.5. And when you do in the middle of each month, you are left with only 5.5 months and 0.5 divided by 2. 6 by 2 is 3. So 3 will be your average period. And when you do at the end of each month, so you are left with only 5 months and nothing on the end. So 5 by 2, which is 2.5. So it's very easy to remember if you are able to draw a timeline of the entire period for which you are going to do the calculation. So let's get into the very important part of the subject, which is your journal entries. So being interest on drawing is basically a revenue, right? So going by the golden rules, nominal, you have to credit interest on drawings, and debit will be partner's capital account. That is your first entry. You can refer to page number 2.44 where they have discussed the journal entry. So you are going to credit interest on drawings and debit partner's capital account or current account based on the type of capital they are having, and then we are going to transfer it to P&L appropriation. So we have interest on drawing account debit to P&L appropriation account. So please remember, first this has to be treated as an income. So we'll credit interest on drawings and debit partner's capital or current account, and then we'll transfer it to P&L appropriation, right? So it is going to be IOD to P&L appropriation account.